Wall Street was again rattled by another wave of sell-off yesterday in AI-related stocks and their victims, a sign that the AI pressure is gently spilling beyond the technology to traditional businesses. But the week hasn't said its last word just yet. Attention now turns to the US CPI release later today. And if inflation shows further signs of easing in the US, the Fed would be in a better position to lower the interest rates, and that could offer some relief to an economy and market that's been increasingly rattled by AI-related uncertainty and potential job displacement. But if the relief doesn't come, however, the sell-off across major US indices could develop into a 10 to 20% pullback. That scenario is not a forecast, but it is well within the realm of possibility. So welcome to Swissquote's Daily Market Talk. It's Friday, February 13th. I'm İpek Özkardeşkaya. And everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So Wall Street had an ugly session on Thursday. Technology was mostly responsible for most losses, but not for the same reasons. Cisco, for example, plunged 12% yesterday as the company reckoned that the rising memory chip prices will squeeze their profit margins. Magnificent 7 dived 2.30%, pulling Nasdaq 100 down by 2%. Then the software sell-off continued at full speed yesterday, with iShares expanded technology software ETF down by as much as 3.5% at some point during the session. The ETF closed yesterday's trading session with a more than 30% discount compared to last September's peak levels. And logistics companies joined in the race to the bottom this time, as another startup called Algorithmic Holdings, a previously karaoke company, announced that it improves its customers' internal operations to scale freight volumes by up to 300 to 400% without a similar increase in operational headcount. So their shares soared 12% to $1.50 per share. On the other side of this trade, State Street's transportation ETF tanked nearly 4%, while Russell 3000's trucking ETF fell nearly twice that amount. And there is more to this story, because according to Morningstar's pitch book, the amount of distressed loans, meaning loans backing software companies that now trade below 80 cents on the dollar, doubled in volume in January. That tells us that the market is now pricing in the future as if the cloud and likes will be replacing SaaS, so service as a software, for good, and all of these companies will be condemned to a slow death. That's probably a bit extreme though. Because yes, easy coding and easy creation of software will increase competition in the sector. The software companies will see their profit margins squeezed by higher competition, and we will probably see a sector-wide consolidation through M&As. But in fine, the companies will equip their SaaS models with AI probably, and sell more customizable products to their clients. Because I can't really imagine everyone building their own systems and applications just because they can now do it easier. Replacing a core SaaS platform is effectively open heart surgery for an enterprise, says PitchBook. And they are probably right. So I believe that the sell-off that we see in the software space is justified to some extent, but probably overdone at this point in time. So what's next? Will we see McDonald's caught up in the AI sell-off because robots will be replacing humans and they won't be craving burgers as we do? Possibly. When the market is caught up in such a move, well, we tend to see overreaction before calm returns. But a more interesting question here is, could the SaaS apocalypse impact broader market sentiment? And if yes, to what extent? And will the next bubble burst, for example, come from the software debacle and not from big technology companies? Well, I can't tell that, but if the stress remains limited to software space only, and maybe within the broader technology space, we are likely set for further rotation. Rotation toward non-technology and non-US pockets of the market. This is what's happening since a few months now and is more about reshuffling than a full-blown breakdown. But if the stress spreads further, and yesterday's sell-off across logistics stocks is actually a bit worrying and looks like a red flag, then the AI angst could turn into a full-blown macroeconomic issue. You would then go from AI will help us become superhumans and increase our productivity to AI will eat our cake and starve us to death. If that's the case, most sectors could then face broader multiple compression, earnings downgrades, and a more meaningful correction. It would be more than just a technology-specific wobble. And if that's the case, obviously the rotation trade wouldn't work anymore. The good news is, for now, the continuation of the rotation and diversification away from technology is still the most plausible scenario. Amundi's MSCI World ex-USI Index is up by 7% since the beginning of this year, while the S&P 500 is pretty much flat. The Asian stock markets have been outperforming their US peers due to their exposure to the pockets of the technology market that actually benefit from the rising AI demand, and I'm really thinking about the memory chip makers, for example. As such, the Korean Kospi, where memory chip makers run to fresh record highs almost every day, champions the rally so far this year with a more than 30% surge since the beginning of January. European Stoxx 600 Index, on the other hand, is more or less immune to the technology wobbles of the day, as there is not much technology on the continent, and right now it helps to be less exposed to technology. And same is true for the FTSE 100 that's crowded with energy and mining stocks. The index is an interesting diversification to a global portfolio and could be an efficient portfolio protection from the global technology tornado when it is hedged well against sterling risk, of course, and when metal prices behave normally, of course. I'm saying that because the metals are not behaving normally. Yesterday's technology sell-off again hit precious metals prices. Here we are talking about an incredibly unusual positive correlation between gold, for example, and equities. Normally, you would expect gold, which is a traditional safe haven asset, to amass a part of the capital outflows from the risk assets and higher gold prices to lift the FTSE 100's gold miners, for example. But not right now. Not right now. Gold moves in tandem with risky assets and technology in particular. The price of an ounce slipped below the $5,000 psychological mark during yesterday's risk sell-off, pushing Fenello, for example, down 4% in London trading. The yellow metal is better a bit this morning in Asia, but sees resistance into the 5,000 psychological resistance this morning at the time I'm talking here, while Bitcoin is testing the $65,000 support to the downside. The US sovereign bonds is where capital is flowing right now. I'm not even sure that we could call them safe anymore. So the weather is not great, but the week's got one more card to play in its pocket, and that's the US CPI update that's due later today. Both headline and core inflation metrics in the US are expected to have eased to 2.5% level in January, moving closer to the Fed's 2% monetary policy target. If that's the case, if inflation eases in the US, the Fed will be in a better position to lower the interest rates and give some relief to the economy that's been rattling by AI concerns and job losses that could follow. Because if AI doesn't take people's jobs, possible bankruptcies due to AI could. So the thinking goes, a set of soft and ideally softer than expected CPI update today from the US could pull the yields lower and throw a floor under the equity sell-off, while a set of stronger than expected CPI could inject further stress into the market and trigger a further sell-off across risk assets. Now, I hate saying that, but the sell-off that we see today across major US indices looks just like the beginning of a correction. And if the correction develops further, a 10 to 20% pullback in Nasdaq, for example, would be a real possibility. It would even be healthy, I would say, after the past 3 years almost uninterrupted rally, except for the post-Liberation Day sell-off, of course, and that could bring Nasdaq all the way down to 21,000 to 23,500 range. Now, I'm not saying that this is what's next, but I'm saying that it's well possible. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.